Hello traders, welcome back to our Babypips course. For today we are still on course 10 of 11 undergraduate senior, and the course outline reads risk management, the number one course of data forex traders, position sizing, which we have discussed. But today we're going to be looking at setting stop losses. Okay, so under setting stop losses we have these subtopics like what is a stop loss, how to set a stop loss based on a percentage of your account, how to set a stop loss based on support and resistance from charts, how to set a stop loss based on price volatility, how to set a stop loss based on time limit, 4 big mistakes traders make when setting stops, 3 rules to follow when using stop loss orders, and summary setting stop losses. Okay, so that will bring us to the end of this subtopic number 4, setting stop losses. But before we dive right into the very first one of what is a stop loss, let's roll the intro. So here we are on the very first subtopic, and it says what is a stop loss. So basically, managing and preserving your trading account or your trading capital is your most important job as a trader. It's more important than the profits you want to make. Okay, now if you lose all your trading capital, there's no way you can make it back. Okay, the amount that is lost is already gone. Okay, so you are out of the trading game. So if you make pips, you have to be able to keep those pips and try not to give it back to the market. But let's face it, okay, we all make losses. We take loss, and we also make some profits. Okay, so every day is a new challenge, and almost anything from geopolitics, surprise economic data releases to central bank policy rumors can turn currency prices one way or the other faster than you can snap your fingers. Okay, this means that each and every one of us will eventually take a position on the wrong side of the market. Okay, so what does that tell us? That tells us that we have to, be very pragmatic, right? And proactive as well in terms of saving our trading capital, or protecting our trading capital. Okay, so being in a losing position is inevitable, but we can control, when we are caught in that situation. You can either cut your losses quickly, or you can ride the losses in the hope that the market is going to move back in your favor. Of course, that one time you are hoping market is going to move back in your favor, okay, could turn your trading account to zero. Like, it can literally blow your trading account in a twinkle of an eye. So the saying that live to trade another day should be the motto of every trader or on newbie island, because the longer you can survive, the more you can learn, gain experience, and increase your chances of success. So this makes the trade management technique of stop losses a very crucial skill and a tool in every trader's toolbox. So having a predetermined point of exiting a losing trade not only provides the benefits of cutting losses so that you can move on to new opportunities, but it also eliminates the anxiety caused by being in a losing trade without a plan. So less stress is good, right? Now, of course, it's easy to cut losses and to move on to better, opportunities. Okay, so your stop loss should be the invalidation point of your trading idea. So remember when you went for a blind date, and at some points, you said to yourself, oh no, this blind date is not going to work, I've had enough, and you wanted to leave, and boom, you left, right? That's a stop loss in your dating game. Okay, but in trading, it's almost very similar. When the trade goes in the opposite direction you intended, just know, buddy, it's time to get out. Okay, so what do you have to do? Just suck it up, take it as a loss, okay, and just move on. Be a big boy, grow some courage, and move on. So why is it good for you to use stop loss? The main purpose of a stop loss is to ensure that losses won't grow too big. Now let's take 2 persons as an example, Kylie and Kendall. Now both Kylie and Kendall trade exactly the same way. Okay, the only difference is being their stop loss sizes. Now Kylie, trades a stop loss size of Kylie trades a stop loss size of 10% of her total account, while Kendall trades a stop loss size of 2% of our total account. Now the same trading strategy, it only has two possible outcomes. One is take profit, while the other is a loss. Now this means that both profits and both strategy exits when the stop hits either TP or stop loss. Now let's say both of them now go on a losing streak, right? They both lose 10 trades in a row. Kendall's account will be down by 20% because she's using 2%. So 2 times 10, 20, right? Now Kylie, on the other hand, has blown her account because she's using 20%. Okay, now 20 times 10, that's 100. Her account is gone. So we have to give her rest in peace. So using a stop loss decreases the risk of blowing your account and works to protect your trading capital. So in the next section, we'll be discussing different ways of setting stop losses. For instance, the first one is percentage stop. Second one is volatility stop. Third, chart stop. And the fourth, time stop. So are you ready? So let's get started if you are ready to rumble. But before then, okay, please smash the like button and subscribe. If you don't even subscribe, smash the like button. Why? Because it helps with the algorithm. YouTube helps to know, okay, this channel, this video are getting likes, people are viewing it. Okay, let's show it to other people as well. Okay, so your like is helping people who are also interested in learning baby pips to benefit the same way you are. So please smash the like button and subscribe, and then we shall see in the next lesson that says how to set a stop loss based on a percentage of your account. So here we are on how to set a stop loss based on a percentage of your account. So the percentage-based stop loss uses a predetermined portion of the trader's account, right? For example, 2% of the account is what a trader is willing to risk on a trade, and so you calculate, the risk of that 2% into your lot sizes, and with that 2% you determine your entries and where your stop loss is going to be. Now mind you, some aggressive traders, they risk up to 10% of their account, while some less aggressive traders risk only 1% of their account per trade. So once the percentage risk is determined, the forex trader uses his position size to compute how far he should set his stop away from his entry. This is good, right? A trader is putting a stop which is in accordance with his trading plan. This is good trading, right? Wrong. No, it isn't a good trading. You should always set your stop according to the market environment or your system rules or your trading rules, not how much you want to lose. Do you understand? Set your stop according to the market environment or according to your rules, not how much you want to lose. Now you might be thinking, well, but that's wrong. That you mean it's not correct, right? It's confusing to you right now. Yes, it is. Now let's go back to the example of the newbie Ned with a mini account of $500 and with a minimum size he can trade being 10k units. Now Ned decides to trade GU as he sees a resistance at 1.5620 that has been holding. Now with regards to his risk management rules, Ned just wants to risk 2% of his account per trade. Now at 10k units of GU, each pip is worth $1 and 2% of his account is $10. Now the largest stop Ned can use on his on this, okay, is 10 pips, which is what he does on this trade by putting his stop at 1.5630. Okay, it was 1.5620 plus 10 pips, 1.5630. Now look at the chart and look at where his stop loss is. Okay, so look at the resistance, 1.5630 and 20 rather, and his stop loss just 10 pips of 10 pips ahead of it. Now so let's see what happens. Now the GU moves over 100 pips a day. He could easily get stopped out at the smallest GU move. Now because of his position, because the position limits his account, okay, Because of the position limit this account is set to, he is basing his stop solely on how much he wants to lose, instead of the given market conditions of GU. So let's see what happens. There is a huge spike up, he was stopped out, and the market moved down to his favor. No, but yes, many of us have experienced this. I'm sure you too might have experienced this as well. So from that example, you can see that the danger with using percentage stops is that it forces the trader to set his stop at an arbitrary price level. It is either that stop will be located too close to the entry, like the example we have, or at the price level, or at a price level that doesn't take technical analysis into account. Okay, so because he has already been stopped out, you or he wouldn't be able to bargain those pips that run down the other side, the actual side of the market which he predicted, right? So in this case, Ned should try and trade with a forex broker that allows him to trade micro or even custom lots. So at 1k of GU, each pip is worth 0.10. So in order for him to stay within his risk comfort level, he will set a stop on GU to 100 pips before losing $2 of his account. So do the math. 100 pips multiplied by 0.10 is equal to $10. He now has the ability to set his stop to the market environment, trading system, support and resistance, etc., etc. Did you like how we just went through this section? Please smash the like button. It helps with the algorithm. Subscribe if you haven't, and I'll see you in the next lesson that says how to set a stop loss based on support and resistance from charts. So here we are on how to set stop loss based on support and resistance from charts. Now, from the previous lesson, we learned that setting stop losses using percentage-based amount of your account is wrong and deadly. Now, a more sensible way to determine stops would be to base it on what the charts are saying. Like, we can always tell the direction of the market just looking at the charts, okay, technically, okay? So one of the things we can observe is that price action, okay? So many times we see that price action can't seem to push or break beyond certain levels. So oftentimes when these areas of support or resistance are retested, they could potentially hold the market from pushing through once again, potentially, right? So setting stops beyond these levels of support and resistance makes sense, because if the market does not trade beyond these areas, then it is reasonable to think that a break of that area will bring in more traders to play the break and further push your position against you. Or if these levels do break, then there may be forces that you are unaware of that suddenly is pushing the market one way or another. So let's look at this example here. The market has been pushing down, that's been respecting this red trend line, and all of a sudden there is a break. So a break above the trend line, okay, it will suggest that you should buy. But where are you going to place your stop loss? Okay, so from the chart above, we now understand that we have a breakout. We have to take a trade, a buy to go long. But where could your stop loss possibly be? What conditions will tell you when your trade idea is invalidated? Now, from this example, again, okay, it will not be safe to put your stop loss here, okay, but it will be more safer to put your stop loss below the black trend line that is signifying support. So your stop should be below this area here, and then you can confidently say, okay, this market is safe to trade. And what happens if the market comes and reverses and smashes your stop loss that is below this black line? Don't adjust. Just know your trade plan, your idea, everything, trade setup has been invalidated. You are wrong. Take it in and move on. Okay? Just take it in and move on. Now let's use another short example here. Let me just explain using this diagram. Okay, now from this picture we are looking at, okay, we can see this trend line has been respected more than 4 times, okay, and the prices is coming up gradually. So where could our entry and stop loss and take profit be? Possibly be. No, it can be placed, your entry can be placed here, right? You expect price to come to touch this black trend line again, okay, which is acting as resistance. Okay, then your stop loss can be here, okay, and then you can have to take profit 1 and take profit 2. So now let's see if this trade went according as planned. Now we got filled in, we got triggered into the market, okay, and then the first position smashed take profit, and the first TP was made, second TP was missed, by just one measly pip. Okay, so that is how the trade went. Look at entry here, look at take profit 1, and then this is take profit 2. That was slightly missed. So in the example above, using resistance as a guide on where to place your stop loss instead of simply using a fixed number is very, very beneficial to you. So once again, if you like this lesson, please smash the like button and hit subscribe. It helps with the YouTube algorithm so that you and I can support and help other people to be directed to this channel and benefit from these videos as well. So once you smash the like button, I'll see you in the next lesson that says how to set a stop loss based on price volatility. So here we are on how to set a stop loss based on price volatility. Now, volatility simply means the amount a market can potentially move over a given period of time. Okay, so knowing how much a currency pair tends to move can help you set the correct stop loss levels and avoid being prematurely taken out of a trade on random fluctuations of prices. So for instance, if you're a swing trader and you know that Euro USD has moved 100 pips a day over the past month, setting your stop to 20 pips will probably get you stopped out too early on a small intraday move against you. So knowing the average volatility helps you set your stops to give your trade a little breathing room and a chance to be right. Okay, so method number 1 is using Bollinger Bands. Now we know how Bollinger Bands work. Once you throw all Bollinger Bands into the chart, the price action will be contracted, will all trapped inside the Bollinger Bands. And now if the price touches the top band, the bottom of the bands, okay, which is also the EMAs, either way, it's time to buy or sell. Now where will be your stop loss? Okay, your stop loss will be safer above the bands, okay, or below the bands. Either way, either you are going long or you are going short. So that's the benefit of using Bollinger Bands. It's much more easy. It helps you to know the range trading, okay, within a given period of time. Okay, then the other indicator you can use is the average true range, or ATR indicator. This is a common indicator that can be found on almost all charting platforms, and it's really easy to use. Now the ATR requires that you impute the period or amount of bars, candlesticks, or time it looks back to calculate the average range. Okay, so for example, let's say you are on a daily chart, okay, and you impute 20 into the settings, then the ATR indicator will calculate the average range of the pair over the past 20 days. Why? Because you are on the daily chart. However, if you are on the hourly chart and you impute 50 into the settings, then the ATR will calculate the average movement of the last 50 hours. Simple, right? So look at this example. So if you know this is the average movement, okay, for the past 50 hours or whatever, where will your stop loss should be? Your stop loss should evidently be below the ATR range. Okay, here, or here. Okay, but this can easily spike and come down. Whatever, every market is crazy. It can do whatever it wants to do. So being at the very, very safe side is very, very good. So this process can be applied by itself as a stop or in conjunction with other stop loss techniques that you have in your trading toolbox. So the point is to give your trade enough breathing room for fluctuations here and there before it heads your way, and hopefully it does head your way to smash your take profit. Okay, so please, one more time, if you enjoyed this lesson, okay, and once we have been discussing so far, smash the like button. You are doing so to help the algorithm to show this video to other people who wants to also benefit from this video just as you are benefiting. So please smash the like button, subscribe if you haven't, and I will see you in the next lesson that says how to set a stop loss based on a time limit. So here we are on how to set a stop loss based on a time limit. Now this section is just saying set a stop loss on a predetermined time in a trade. Okay, so it could be, you know, hours, maybe it could be days, maybe it could be weeks or months or what have you. Okay, but the point is you should only trade during a specific trading sessions. Okay, the market opens, the market is active, and the market is, market is on. That is when you should trade. Okay, don't just sit and wait for your trades all day long. For instance, let's say you are an intraday trader and you have just put on a long trade on Euro CHF and it hasn't gone anywhere. Okay, we are talking really snooze here, right? Snooze V rather. Pardon me. Okay, so it's snoozing. Look at the market. So before you actually, take either buy or sell, just go do it like 5-10 minutes. Look at the charts. Is it going sideways or is it pushing up or down? You always want to trade in a market like this that's either pushing up or pushing down. Why? Because the more pips the market move or pushes, the more money you make. Okay, so maybe you are a swing trader and you decided to, okay, I've traded all Mondays till Friday, I don't want to hold my trades all through the weekend, like Fridays, like Saturdays, Sunday and all that, to avoid gaps and news that come in every Monday or what have you, and you decide to close your trade over the weekend. Okay, and that's very good because closing your trades on Friday helps a lot because like on Saturdays and Sundays you actually experience a huge spike, huge gaps, huge spreads as well on your trades. Okay, so if you are holding your trades over the weekend, you actually pay more. There's also rollover cost and all that, so you have to consider all of that and put it into consideration before you decide either to hold the trade more than a day, week, or what have you. So set a time and cut off the dead weight of your money and make your money work. Instead of putting your money somewhere here, make sure you put it here so that it can work for you. So the next lesson we're going to discuss right now is, please, before I say that, smash the like button if you have not. It helps with the algorithm. I'll keep reminding you. Okay, it helps with the algorithm, so please smash the like button, subscribe if you haven't, and in the next lesson we're going to discuss 4 big mistakes traders make when setting stop loss. So here we are on 4 big mistakes traders make when setting stops, and the very first one is placing stops too dang tight. Okay, if it is too tight, your trade will have no room to breathe. And what happens if the pair is really volatile? You see all the spikes up and down, and it is not surprising that you get stopped out before the market goes into your direction. Okay, so please give enough breathing room. Okay, give enough breathing space. Okay, give your trade enough breathing room and take volatility into account. Now, the second reason is using position size like X number of pips as a basis for stops. Now, using a position size like X number of pips as a basis for a stop instead of technical analysis to determine stops is a bad idea. Use technical analysis. Okay. Now, remember the example of the newbie net we were using position sizing to calculate how far your stop should be has nothing to do with how the market is behaving, whereas you must consider market behavior in using position sizing and also in using your stop loss. So since we are trading the market, it makes much more sense to set stops depending on how the market moves. Okay, do you get that? Since we are trading the market, not trading money, since we are trading the market, it will make much more sense to set stops depending on how the market moves, which is market environment. That's what we are trading, market behavior. Okay, so after all, you picked your entry points and your targets based on technical analysis, so you should do the same for your stops. Don't go this way. Don't go position size equals to risk equals to stop loss. No, go this way. Size of stop loss plus risk plus position size. Okay, try and fathom it that way, tweak it that way into your that will benefit you. See, okay, so we are recommending that you should decide where to place your stops first before calculating your position size. That's what Babypips is telling you and I. Now, placing stops too far or too wide is another reason why, it's another mistake traders make when setting stop loss. So placing a stop loss too wide or too far is dangerous. Why? Why do you want to hold a trade for 1, 2, 3, 4 days, whereas it's going into your, it's going in the wrong direction just because you place your stop there? Okay, no, don't do that. Okay, what you should be doing is that your stops shouldn't be too far. If your stops are too far, it increases the amount of pips your trade needs to move in your favor to make the profit, and also it also enlarges your losses capability. Okay, you are more likely to incur more losses because your stops are way too far. So with a good risk to reward ratio of say ratio 2 to ratio 1, okay, you'll be likely to end up with profits if you are right on the on the money with your trades for at least 50% of the time. Okay, so use a 1 to 2 risk to reward ratio or 1 to 3 risk to reward ratio. So let me give you a very quick example. Okay, so this is a trade. Let's say this is short. Let's say we sold what is it here? This is AU, right? So let's say we sold AU right there, right? Now this is a 1 to 1 risk to reward ratio. Okay, so let me just manually adjust this so that if you look here, risk to reward ratio is 1, right? Now, so it is now going to 2 and it's now going to 3, right? Yeah, so that's 3, but you can use 1 to 2 like what Babypips is suggesting. Okay, so this is a 1 to 2 risk to reward ratio. Okay, fine. Let's say you took this trade here, if possible. I don't know, not sure. Or let's say you even took this trade here, right? And market is not right, it's not there right now. So let's say this is your stop loss at the top this way, right? And this is what the risk is 1.37. So we have to get if we are using 1 to 2, we have to get 2.3 plus 6 2 points. Let's hold on. 2.71 74 rather. So 2.7471 whatever, this should be your risk to reward ratio. Okay, so by the time you get filled in at this level here, okay, you want to wash, set everything down. When you smash your take profit, you are out of the trade. So where are we? That's placing using a 1 to 2 or 2 to 1 risk to reward ratio. Now the last reason is placing stops exactly on support or resistance level. Setting stops too tight is bad. Setting stops too far is bad. Now, where exactly should you place your stop? Okay, not exactly on support or resistance level. Okay, we can tell you that, but just make sure it is just below support if you are buying. Make sure it is just above resistance if you are selling. Okay, so that's the best approach to go through it. Now, like we have just said, this is how we come to the end of this lesson. 4 mistakes traders make when setting stop losses. So if you like this session that we have discussed so far, please smash the like button. It helps with the YouTube algorithm to show this video to other people, other newbies as well, so they can come and benefit as well. Okay, so smash the like button, subscribe, and I'll see you in the next lesson that says 3 rules to follow when using stop loss orders. So here we are on 3 rules to follow when using stop loss order. So once you've done your homework and everything, you've planned your trade, how you want to go in, how you want to go out. Now, some persons do automatic stop out, like we have seen in this example we did here. Once we input all these figures, stop the risk, entry, how many ticks, and the stop loss level. Once you input that into your MetaTrader 4, okay, You input that into here, stop, okay, and what have you. Let's just do one example and see. So let's say we are on GU, right? Let me go to the 5-minute time frame. Okay, so this is GU. Now if I am going to trade this, I will say this is my resistance, okay, considering this level here as well. This is my resistance. Okay, so we're good. Now what is my support in this 5-minute time frame? I can put my support here, right? So let's say I want to go, I want to short this trade, okay, because it has been coming down for a very long time. So I say, let me say I want to short this trade. So I want to put my entry where, if I want to put it exactly as resistance, it will be 3220. Okay, so let's say, let's go for example, pending order, sell limits at the price of 3220. Now the stop loss would be at, okay, so let me add like how many pips stop loss to it? Let's say, okay, let's just make it here 3230. Okay, yeah, 3230, and take profits. Let's say I want to make our take profit in this place 3200, and take profit is here at 3200, and you say place order. Boom. So when it comes, it fills you in. If it's going against me and prices is here, okay, it stops me out. If it comes in my favor and smash my TP, take profit, I'm in profit. So everything happens automatically, just like that. I hope you understand that, right? So this trade is active. I don't know if I'm going to leave it. Let me just see. No, I don't like this. Market hasn't pulled back enough for me, so I'm going to close this, and we're going to go back to this level here. Here we are. So I hope you get the idea, right? So when you use automatic, which is what we have just done, it goes, it takes your profit, or it hits your stop loss. Now other traders do mental stop. That is to say, they just watch the market and say, okay, when it gets here, I'm going to close it from my mind. I know I'm not going to do this anymore, I'm going to close it. Okay, now traders who do mental stops, they are much more professional traders and highly professional. They've got lots of years of experience. But many of the professional traders I also know and follow online as well, they don't even do mental stops. Okay, they do automatic. They just place their trades, put their stop loss at their take profit, and they let the trade ride, win or lose. Okay, they are so disciplined. Okay, so don't go through mental stops. Okay, make everything automatic and be disciplined. Discipline is when you say, okay, my trade is no longer valid, I'm not going to widen my stop loss, I'm just going to take it as it is, suck it up and take it as it is. Okay, so discipline is when you actually do and stick to your guns. Okay, for example, a trader who says, I will not widen my stop, all of a sudden he begins to widen his stop and widen his stop, which is not highly recommended. So use limit orders like we just did in the example which I showed you here on MetaTrader 4. Use limit orders. It automatically fills you into the trade and also close you out if you hit a take profit and if you also hit a stop loss. Okay, so it is highly recommended that you use limit orders to exit the majority of your trades. So let's move to the 3 rules of setting stop loss. Rule number one, do not let emotions be the reason you move your stop loss. Okay, while your initial stop loss, your adjustment should be predetermined before you put on your trade on. Don't let panic get in the way. Okay, then rule number 2 is trade your stop. Okay, trading stop means moving in the direction of your winning trade. Okay, so this locks in profits and manages your risk if you add more units to your open position. Then rule number 3 is don't widen your stop. Do not adjust your stop like we have been said. Okay, like this man here. Okay, he said he wasn't going to do that, but all of a sudden he did that. And if you widen your stop, you are going to incur more losses than you ever imagine. So do not widen your stop, or else you will end up like this guy here. He lost a lot of money. Okay, so that brings us to the end of this lesson, and for us to move to the next lesson, please smash the like button, subscribe if you haven't. It helps with the YouTube algorithm to help to show this video out to more people as well. Okay, so I will see you in the next lesson that says summary setting stops. So here we are on summary setting stops. Well done. We've learned a lot setting stop losses, and we've also learned how we should find a good broker that allows you to take position size that can suit your capital and risk management rules. Also, we also use the word predetermine a lot, because you should always know when to get out before you open a position. Okay, know when to get out. So once you have factored all this into consideration, and you set your stops according to the current market environment, framework, and trading method, you should be very, very good. Then do not set your limits, your exit limits, to how much you are willing to lose. Set it according to market environment, and also consider technical analysis as well. Then find the stop levels that prove your trade wrong first, and then manage your position size according to it. Okay, find the stop levels that prove your trade wrong first, and then manage your position size according to it. Use limit orders. This will help you a lot. Okay, it will automatically fuse you into the trade, close you out when you hit stop loss, or close you out when you hit take profit. It makes life easy, and you don't have to sit in front of the computer all day long looking at what to do or what not to do. It will also eliminate all forms of emotions and FOMO. Now, only move your stop in the direction of your profit target, that is trailing your stop loss, which is very, very good. Okay, widening stops are very, very bad. Do not widen your stop losses. Okay, markets are very dynamic and volatile as well. Okay, so if you continually practice the correct way to set stop records and review your trade processes and your trade outcomes in your journal, then you'll be one step closer to becoming a professional risk manager. Remember, our job as forex traders is to protect our trading capital first. Risk before reward. Okay, so if you like this lesson so far, please smash the like button, subscribe if you haven't, and until next time, I'll see you in the next class.